Capital market or market for long-term funds. Definitions. Capital market is the market where long-term funds are found, unlike money market where one finds short-term securities. Capital market encompasses all the institutional arrangements and facilities for lending and borrowing of medium and long-term funds for economic development, where the demand for long-term capital comes mostly from government and private sector manufacturing industries. There's a demand side and a supply side for funds, and in the case of capital market, the supply of funds come from savings bank, insurance companies, individual savers, specializing financing agencies and corporate savings. Capital market is separated into industrial securities market and gilt-edged market. Gilt-edged securities are normally traded in the market in stock markets with stability in value and are mostly looked after by banks and other institutions and are government and semi-governmental securities. Industrial securities market is a market for debentures and shares of new and old companies, which is further divided into primary market and secondary market. In primary market, industry raises funds by issuing different types of securities which are directly issued to investors. These investors may be institutions as well as individuals and buy the shares of company directly from the company. The new issues of securities are placed in the form of rights issues, public issues or private placement. Private placement the majority of the cases. For the efficient operation of this market, there exist financial intermediaries in primary market who are registrars, merchant bankers and issue houses, which helps the market to operate effectively and best functionally. Once the securities are issued, the secondary market is the network where subsequent sale and purchase of securities happen. On allotment of shares in the secondary market, the securities can be sold and purchased in the secondary market, which is completely or almost completely represented by stock exchanges. In capital market, the stock exchanges provide an organized marketplace where investors trade in securities in the stock market. IPO, Initial Public Offering. A company in India can change from a private limited company to a public limited company through the process of an IPO or an initial public offering. IPO refers to the process of offering of shares of private companies to public. In other words, an IPO allows a company to raise capital from its public investors. IPO registration. The first step for an Indian company for becoming an IPO is to hire an investment bank or underwriter who acts as an intermediary between the investors and the company. Normally, the deal details, amount to be raised in an IPO, and the securities being issued are finalized by the underwriting firm. Next step for a company becoming an IPO is in registering the company along with a draft prospectus, also known as red herrings prospectus, which is a mandated requirement by Companies Act along with compulsory disclosures as per SEBI, Securities and Exchange Bureau of India, and Companies Act. SEBI verifies the documents of the company, and if approved, the company can decide upon a date for an IPO. The company then makes an application to stock exchange floating of its initial issue. By a roadshow, the company may create a buzz in the market. Company initiates the price of its IPO, whether a fixed price IPO or by book binding offering. Investors place their bids as per company's quoted price. Once the IPO price is finalized, the company along with their underwriters disclose the number of shares allotted to its investors. In the case of over-allotments, partial allotments may be made. In general, companies must meet requirements by SEBI, and those companies whose private valuations reach $1 billion attains a unicorn status, Aileen Lee. These companies who are unicorns or whose fundamentals are proven or who has remained profitable has a higher chance of becoming an IPO. Equity market. Equity market denotes a market for equities which is characterized by common ownership interest of shareholders in a company with numerous kinds of shares which are listed as follows. Equity shares. Commonly referred to as ordinary shares, represents a form of fractional ownership in a company in which the shareholder undertakes the maximum entrepreneurial risk which is associated with the business where the holders of the shares are members of the company and have voting rights. Rights shares. Rights shares involve issuing new securities to existing shareholders where the shares are distributed in a ratio of their existing shareholding in the company. Bonus shares. Accumulated reserves from profit earned in previous years are capitalized and shares are then issued to shareholders of the company free of cost. Preferred stock. Owners of preferred stock are entitled to a dividend which is fixed or calculated at a fixed rate and paid regularly before dividend can be paid for an equity share. In the question of payment of surplus, preferred stock owners enjoy priority over ordinary shareholders. For a company that is getting liquidated, the claims of preferred stockholders come below that of claims of company creditors, bond or debenture holders. Cumulative preference. In this type of shareholding, the dividend accumulates if remains not paid. Arrears, if any, which is owed to this type of shareholders have to be paid before paying equity share dividends. Participating preference. After a specified fixed dividend is contracted to be paid, this type of shareholders participate in profit where the participation rate is linked with amount of dividend paid for ordinary shareholders over and above a particular or definite level. Debt market. Debt market is characterized by debentures, bonds and security receipts as explained. Debentures are instruments issued by a company which are debt instruments with principal amount repayable by the company on a particular date bearing a fixed rate of interest. Debentures are made in favor of the debenture holder and secured against assets of the company. Bond is a negotiable instrument or certificate which is an evidence for indebtedness issued unsecured by a municipality, government agency or a company. The bond investor lends money to the issuer and in exchange the issuer promises to repay the loan on a specific date. The issuer pays periodic interest to the bond holder over the life of the bond. Security receipts are receipts or other securities issued by a securitization company or reconstruction company to qualified institutional buyer due to a scheme evidencing purchase by the holder of undivided right to title and interest in the financial asset involved as part of securitization. Securitization is converting a batch of debts into marketable securities. Golden share. Golden shares are a special kind of shares with veto powers overriding all classes of shareholders. With a single share, the holder of a golden share could block any special resolution which may go against the stated goals of the promoters of a venture. Index-linked bonds. An index bond or the value of the index bond fluctuates according to an increase or decrease in inflation rate reflected by wholesale price index. The value of the bond is reflective of payment of a coupon or its redemption value fluctuates as per movements in the inflation rate reflected by wholesale price index. Sweat equity. Intellectual property are contributed sometimes by directors or employee of an organization by way of research or in terms of organizational strategy or software developed for the company. Hence, sweat equities are shares issued to cover every such contribution and are issued at a discount to employees and directors. Capital market institutions and systems. Capital market institutions and systems are covered by the introduction of the following topics: depository system, dematerialization, and SEBI, SEBI. Depository system. A depository is one kind of an organization which holds investor securities in electronic form or DMAT at the request of investors through a registered depository participant, and this is made possible by the following two depository systems in India, namely Central Depository Services Limited or CDSL and National Securities Depository Limited or NDSL, which are registered with SEBI, SEBI. The minimum net worth which is stipulated by SCBI for a depository account is rupees 100 crores. The depository can be compared to a bank which holds funds of depositors and provides services related to securities transactions. Dematerialization. Dematerialization is a process in which paper certificates of an investor are taken back by a company or registrar and destroyed where an equivalent number of securities in electronic holdings of the investor are credited. Depositors normally collect scrips and the receipts and record of account are given back to the investors. A depository participant is a broker on stock exchange that acts as a representative of a shareholder and provides the link between a depository and a client. Transactions relating to a demat stock with a depository happens through the depository participant by opening a demat account. SCBI or SEBI, Securities and Exchange Board of India. Securities and Exchange Board of India was constituted in 1988 by the Government of India to regulate the securities market, to promote development of security market and to protect investors, and in that attempt, statutory powers were given to SCBI by the Government of India. In the month of January 1995, additional powers were given to SCBI in order to protect the interests of investors and to ensure orderly development of capital market in India. SEBI or SCBI, without the prior approval of the Government of India, can file complaints in courts and notify its regulations. Management of SEBI or SCBI. SEBI is managed by a chairman and 5 members and has the following departments, namely Issue Management Department, Primary Market Department, Secondary Market Department, and Institutional Investment. It has 2 advisory committees, one for primary market and one for the secondary market. Global Depository Receipts. Global Depository Receipts or American Depository Receipts are instruments in the makeup of a depository receipt or certificate which is created by an overseas depository bank or ODB issued against ordinary shares or foreign currency convertible bonds of issuing company and is issued to non-resident investors. An ADR or a GDR are negotiable instruments representing a non-US company's publicly traded local currency equivalent shares and is denominated in US dollars. Delivery of ordinary shares of an Indian company is involved when an issue of a GDR or ADR is made, and this is done by issuing of an ordinary share of an Indian company to a domestic custodian bank in India, which in turn instructs an ODB to issue on a predetermined ratio a GDR or ADR. An American depository receipt or global depository receipt can be sold outside India in its existing form, and what happens when it is sold is that the underlying shares arising of any such redemption get sold in India. When an ADR is listed, it is normally listed in a US stock exchange, and when a GDR is listed, it is listed in a European stock exchange. A GDR or ADR may represent a global depository share or an American depository share, respectively. Indian Depository Receipts. An Indian depository receipt is an instrument in the form of a depository receipt created by an Indian depository against underlying equity shares of the issuing company. In the case of an IDR, a foreign company would issue shares to an Indian depository, which in turn would issue depository receipts to investors in India. The actual shares would be held by an overseas custodian who shall ask to issue the IDR to the Indian depository. An overseas custodian is a foreign bank in India registered with SEBI and with the prior approval from the Indian government. IDRs are normally listed in Indian stock exchanges and is freely transferable. The overseas company who issues IDR should have $100 million in paid up capital and free reserves. Mutual funds. Mutual funds collect money of members from savings and invest them in such a way that there is a diversified portfolio of financial assets where the investments go into, with a view to reduce risk and maximize the income. There also may exist capital appreciation for distribution on a pro-rated basis as part of any mutual fund investments. Mutual funds thus stands for mutual help of subscribers for management and portfolio investments, advised or recommended by experts in this field. Participatory notes. Participatory notes is a financial derivative instrument issued against an underlying security or share. It allows dividends or capital gains earned out of the underlying security to the holder of participatory notes. Some of these participatory notes take the form of capped return note, participatory return note, investment note, and equity linked note. They generally fall into the spot based or future based offshore derivative instruments and categories.